Warren Buffett has been called the Oracle of Omaha for good reason. For decades, his investment philosophy has been a beacon of wisdom and patience, guiding countless investors through the unpredictable waves of the stock market. Known for his disciplined approach, Buffett has always championed the idea of sticking to one's principles, especially when it comes to investing. But recently, something unexpected happened that shook the financial world. Warren Buffett just broke one of his own long-held rules, and Wall Street is feeling the ripple effects. Imagine watching a master chess player suddenly make a move that defies all the strategies you've come to expect from them. That's exactly what Buffett did, and it sent shockwaves through investment circles. To understand why this is such a big deal, it helps to look at what Buffett's rule was and why it mattered so much. His rule was about discipline, about not chasing after hot trends, about avoiding speculative bubbles, and about sticking to companies he understood deeply. Buffett's success has always been tied to his patience and his cautious, value-driven mindset. When he breaks that, it raises a red flag. What could have changed? What does he see that the rest of us don't? In this video, we're going to unpack everything surrounding this surprising move. We'll explore what rule Buffett broke, why it's so significant, and what it could mean not only for him but for the broader market. This isn't just about one investor's decision. It's about how a single action can reveal shifts in the financial landscape, shifts that might affect your portfolio, your strategies, and the way you think about money. If you want to stay ahead of the curve and understand the undercurrents moving Wall Street, this story is essential. Let's start by stepping back and remembering how Buffett built his reputation. For decades, his approach was almost unshakable. Buy shares in companies with strong fundamentals, avoid the hype, and hold for the long term. He famously avoided tech stocks for a long time, believing they were too hard to value and too volatile. This was his golden rule. Don't invest in what you don't understand. It's what kept him safe during the dot-com bubble and helped him build unparalleled wealth over time. But this time, he did something quite different. He made a big investment in an area that seemed risky and speculative by his standards, something that Wall Street analysts didn't expect from him. What happened was that Buffett's company, Berkshire Hathaway, took a major position in a tech-related firm that's known for rapid innovation and shifting business models. For many investors, this was a jaw-dropping moment. It wasn't just the size of the investment, but the nature of the company itself. This was not the slow, steady, dividend-paying kind of stock Buffett usually goes for. Instead, it was a company operating in a fast-paced, disruptive sector with a lot of uncertainty. The investment raised eyebrows and sent analysts scrambling to understand if Buffett's strategy was evolving or if something else was at play. So why would Buffett break his own rule after decades of strict adherence? One explanation might be that he's recognizing that the market is changing in fundamental ways. Technology and innovation have become so deeply embedded in the global economy that avoiding them altogether might mean missing out on the biggest growth opportunities of our lifetime. Maybe Buffett sees that the risk-reward balance has shifted and that now, cautious engagement with these companies makes sense. Or perhaps this move is a signal to other investors that it's time to reconsider their own biases about growth sectors. If Buffett is willing to enter this space, even tentatively, it might be a sign that the landscape is shifting beneath our feet. This leads to an important question. Should you reconsider your own investment rules when a legend like Buffett does? Is it a wake-up call? Or just a one-off decision based on unique circumstances? It's tempting to want to follow Buffett's every move blindly, but remember, he has decades of experience and insight that most of us don't. What's important is understanding the reasoning behind his choice and what it teaches us about adapting to changing markets while maintaining discipline. At this point, it's worth thinking about how Wall Street is reacting. The nervousness isn't just because Buffett made an unexpected bet. It's because his move challenges the certainty many investors hold about what's safe and what's not. Markets thrive on predictability, and when a figure as steady as Buffett shifts gears, it introduces a new level of uncertainty. Some analysts are revising their forecasts, some are questioning whether it signals a broader market trend, and others are watching cautiously, waiting to see what happens next. Now, before we dive deeper into the implications and what this means for your investments, I want to take a moment to invite you to subscribe to the channel if you haven't already. We break down complex financial moves just like this one into simple, actionable insights that anyone can understand and apply. If you find value in understanding the moves of legendary investors and how these impact your money, hit that subscribe button and turn on notifications so you don't miss out on future videos. Also, I'd love to hear your thoughts. Do you think Buffett made the right call breaking his own rule? Or should he have stuck to his old ways? Drop your opinions in the comments below. This conversation is just getting started, and your input adds so much to it. Back to the story. Let's explore the details of the investment itself. The company Buffett chose is at the forefront of a rapidly growing sector that has seen explosive growth over the last decade. It's a business that relies heavily on innovation, rapid iteration, and constant reinvention, all things that traditionally don't fit Buffett's mold. Yet, Berkshire Hathaway's move wasn't impulsive or uninformed. Behind it is a careful analysis that weighed potential risks against unprecedented opportunities. This decision also reflects a broader theme that's been emerging in Buffett's recent activity: a willingness to adapt without losing the essence of his philosophy. While he still prioritizes companies with strong economic moats and durable competitive advantages, he's acknowledging that those advantages now often come from technology and innovation. The world has changed, and Buffett is evolving his approach accordingly. It's also interesting to consider what this move says about risk. Buffett is known for minimizing risk, but his move signals that risk today looks different than it did 20 or 30 years ago. It's not just about avoiding volatility, but about understanding how technology reshapes industries and consumer behavior. By investing in this tech-related firm, Buffett may be signaling that managing risk now means being open to sectors once considered off-limits, but doing so with a careful, long-term perspective. What does this mean for everyday investors watching from the sidelines? It's tempting to jump on the bandwagon when a famous investor makes a bold move, but it's crucial to remember that Buffett's success comes from a deep understanding of the businesses he invests in and from sticking to his principles even when markets are irrational. This isn't a call to blindly mimic, but a reminder to stay curious and adaptable. Markets evolve, and so should strategies. Let's look at the market's reaction again. Some stocks in the tech sector saw immediate gains following Buffett's announcement, while others remained cautious. Investors are weighing whether this is a new era where tech dominance justifies higher valuations, or if the traditional value investing principles still hold firm. This tension between old and new philosophies is playing out right now, and Buffett's move is right at the center. As we continue, it's important to remember that Buffett's break from tradition doesn't necessarily mean abandoning his core values. Rather, it highlights the importance of reassessing rules in light of new information and changing realities. In investing, flexibility paired with discipline often leads to the best outcomes. And Buffett exemplifies that balance in this surprising decision. The lesson here isn't just about Buffett or one stock. It's about how we all approach uncertainty and change. Markets will always surprise us, and what worked in the past might not work forever. The real skill is knowing when to hold firm and when to adapt. Buffett breaking his own rule is a perfect case study in this delicate dance between consistency and flexibility. Wrapping up, we've seen how Warren Buffett's unexpected investment choice challenges the traditional wisdom he's long espoused. We explored why this move matters, how it reflects changes in the market landscape, and what it teaches us about adapting investment strategies without losing core principles. Buffett's action is more than a headline. It's a lesson on navigating the evolving world of finance. If you found this analysis valuable, don't forget to leave a like and share it with others who want to stay informed. And if you want to dive deeper into how to adjust your investment approach for a changing market, check out the video linked here that breaks down the next step in detail. Trust me, if you thought Buffett's move was surprising, wait until you see what's coming next in the world of investing. Stay curious,